On this episode, we will be talking with Jay Biggins, the founder of multihousing.com. Jay has successfully completed over 120 purchase and sale transactions since 2001 in the following states: Virginia, North Carolina, South Carolina, Georgia, Florida, Alabama, and Mississippi. Jay currently holds and manages over 1,500 units. Jay's specialties include acquisitions of affordable housing and restabilizing market rate housing from distressed, mismanaged, underperforming condo conversion, condo deconversion to full gut rehabs. Today, our topic is the need to continually transact in all economic environments. Our guest has a professional perspective of having been through the cycles before. Jay, we are excited to have you here. Please tell the listeners a little bit more about yourself.
Well, thanks for having me. Appreciate it. Well, I started a little bit differently than most syndicators. I think most syndicators are able to kind of come in and get some volume and scale relatively right away with other people's money. I started a little bit more kind of street level. I was buying 6 units and then 12 units and then 17 units, and I gradually went up to 50 and then 100, and I would do typically about one deal a year until we came out of the down cycle of 2009 and 10, and they started making some pretty good hits and started buying 2 or 3 deals simultaneously. And now at any given time we are buying and selling 500 units simultaneously. I think this year I purchased close to 1,000 units and also probably sold close to 1,000 units this year. Kind of at an even in terms of net buy, net sell for 22, but very active, and hope to remain active through 2023 despite all the market turmoil that's kind of happening right now.
That's phenomenal. So when you're analyzing a property, or you're finding out which property you want to purchase, a quick back of the napkin analyzing, what would you use to give you a go or a no on a property?
Well, I think most properties can get a fast no in about 30 seconds. And others that pass the kind of back of the napkin test will warrant a little bit of a deeper dive. But believe it or not, I know this is kind of funny for most, but I like to see pictures. I mean, I really want to see a picture of an asset right up front, so I get an idea of what the vintage is I'm dealing with. Of course, it's just exterior. I'm not seeing an interior photo, but I just want to see that. Sometimes I'll get an address and I'll Google Earth it, and I'll see who's riding bikes up and down the streets or whatever it is. But once I kind of can get an idea of a C asset and what the tenant profile may or may not be in terms of strengths or weaknesses, I like to do a quick GRM model, gross rent multiplier, and I simply want to know what's the price per unit and versus the average in place rent. And then I want to know like what the rents could or should be. So for example, if a price per unit is maybe $100,000, I would want to see those rents north of 1,000, preferably 11, 12, 1,300. Obviously, the higher the better. But if you're going to show me $700 rents at $100,000 a door, I know that's a pass. Unless you told me that those rents should be $1,250, and then I'm still going to want to probably negotiate off that level, just because a quick GRM kind of will just use the first digit in the rent to the first digit of the rule, to determine whether what that multiplier is. But
Got it.
Having said that, the lower price per unit, the lower the rent and price per unit, you need that spread needs to widen, just because the operational expense on a $50,000 unit, or rather, let's say a $600 rent or a $700 rent might be 60 or 70% of gross revenues, whereas the operating expenses of a property that has $1,400 rents might be 40%. So it just it depends, but where you want to see that spread. But the lower price rents and the lower price per unit, you want to see a larger spread in the gross rent multiplier model.
Okay. So as investors, we want I feel like our first approach is to see how cheap can we buy the unit. We always want to buy low and sell high. Where have you seen your most success on as far as per rent purchase price? Is it the 50s, the 60s, the 100,000? Because there's a sweet spot.
Well, that's a great question. It's really interesting. And there's really never a right or wrong answer to almost any of this. What I love about multi-housing is we can be sitting at a conference with 10 guys at a table, 10 pros. Maybe you have 5 pros and 5 beginners. I don't know, but many times you have 10 different approaches. And there's really no right or wrong answer. It's just what suits each. But going back to answer the question directly, I've had success at all levels. I bought my largest deal this year in the Gulf Coast, and it was 240 units, and I think we paid 110,000 a unit.
Nice.
And we turned that property over really quickly and had a very nice profit on that. And we've done, I bought many purchases in the $30,000-$40,000 a unit, and have also been very profitable on those, but also have been thin on each end of that spectrum. So I'm a basis buyer, no doubt. I just can't help myself. I love the basis play, but I also don't want to buy high risk tenant profiles. So even though you might have a very low basis play, you see a lot of those, at least I have, in Tennessee, and it just seems like there's a whole bunch of landmines there that I haven't been comfortable with. Certain markets, even though you get a great basis play, that I'll just stay out of.
Yeah. I've found the lower the price per unit, much more attention that we need to put on that property, and it's a much heavier lift, it seems like, and the tenant profiles are tougher to get to where we need them to be at.
I think that's a safe stereotype, but it is yet still a stereotype, because
yeah.
I bought plenty of deals that were very low price per unit that had a very nice tenant profile, and we've done well with those. So particularly senior housing. I love senior housing.
Absolutely, and that's one of your specialties as well, as senior housing, and that's I think I would love to aspire to get to more knowledge around an industry, because that's another thing. That's a whole industry that could be, I guess, when we're collecting rents and ups and downs, and your economy goes down, there's some assets that perform much better in different economic environments. In senior housing, it could be one that outperforms all the rest.
Well, I just think that's, the older we get, we make better parents, we make better tenants. I mean, we've just learned as we get older what the priorities have to be. And for sure, I think you have a better paying tenant profile with seniors than you do any other tenant demographic, just because they experience more in life, and we all know what happens if we don't pay our rent, and we get to the point where we like the reputation of paying on time. There are some cultures that people pay slow, and there's others that pay faster. But tenant profile is important to the extent that you have tenants that have the willingness to pay, not only the ability.
I like that a lot. Should we be net sellers or net buyers in today's economy?
That's such a great question. I feel that we're definitely in a tricky market. I mean, everybody's feeling it to some degree, but I think it's a healthy market. I think we're staying very active. I have many deals pending purchase right now, and I've sold off a bunch very recently. I think the question really is, how are we adjusting our underwrite? And for me personally, I'm adjusting mine to next year's interest rate raises. And, for the last 10 years, it's just been a vertical market. And I've always been a very disciplined buyer. And I felt kind of dumb these last couple of years, because I stuck to my guns and only bought deals that I felt were really going to perform in any situation. And there's been so many people that just bought anything and have made a lot of money. So I felt like I could have been much more profitable and successful had I just bought a lot more. But now that those strategies and those disciplines and strategies are really going to start to pay off, because there's a lot of people that bought 5 caps, which or less, that are C-class assets that really will be underwater when their rates adjust. So I think that's going to create a whole lot of opportunity, or at least it has the potential to. But in terms of being a net buyer or net seller, I think I'm going to be even over the next 12 months or 24 months. And I think the plan really is to adjust underwriting a little bit, so that I don't buy, let's say, an in-place 5.5 and I pro forma it out at 7.5. I do all that work and I create the 7.5, and 24 months later, I'm at a 7.5 cap asset in a 7.5 cap market, and I just worked for free for 2 years. So that's what I'm trying to avoid.
That's you couldn't have said it better. A lot of these groups were purchasing based on pro forma. If you raise the rents, you'll now become into positive cash flow and buying on a 4 cap, 5 cap.
Well, it's been so difficult to acquire the last few years. I mean, quite honestly, I've been wrong about the market for probably 5 or 6 years. I've expected this day for 5 or 6 years now, and there's been so many conversations in our household when I come home and talk to my wife. I'm like, hey, we're going to have to really, think about what our investment dollars are headed towards in the next year, because this can't last. And every year I've had a record year. And quite honestly, 2023 is going to be probably a record year because, I'm always looking 12 months out. Really, I've always had my income earned 12 months out. So if I don't really have my 23 income earned at this point, I'm in a little bit of trouble. So anything that we're going to really earn in terms of equity gain, we've already done that. We just haven't haven't put that in a disposition bucket yet. But it's coming, and we kind of know where our values are. So really feel pretty good where we sit for 23. What 24 is going to bring, nobody knows just yet. So that's a lot of the acquisitions maybe we're doing right now, or properties we're stabilizing right now. And which means we've bought them sometime, within the last several months, or, maybe last year. But I think the market's tricky. It's going to continue to be tricky. Nobody has lenses that look very far out, but it is important to try to see as far out as we possibly can. And I think at the moment we can all see, somewhere between 6 to 9 months. Whether we see beyond that, who knows? I think one of the drivers could be, again, some of these mortgages that have been taken over the past 36 to 48 months that maybe have 5-year balloons or 5-year resets. How do you handle an acquisition at a 4 cap that you really that's now going to, well, unless you've had some rent raises that will compensate. But when those rates go to 7 or 8% and they've been underwritten at 3.5 or 4, I mean, it's going to be tricky, and some people won't make it.
Yeah.
So,
their disposition was underwritten at a 3.5 or 4, refinancing at a lower rate. I'm with you.
I think what could be the savior in those cases is that the rent growth has been significant. But in some cases, maybe it hasn't been so much, or people didn't upkeep the property enough to when the rent raises may have been available otherwise, but maybe didn't put the CapEx dollars in needed. It'll just be a little bit interesting. We don't know really what that's going to look like, but it's certainly on the horizon where that's going to be a challenging time with so many rent resets heading.
I'm with you. So every market we know has got a primary, a secondary, and a tertiary market. How do you feel about tertiary markets?
Well, I like tertiary markets. I make a living in tertiary markets. Some people's view of a tertiary market is a little different than others, but I'll go pretty tertiary, but not towns that maybe have less than 20,000 people. I have many times bought deals in towns where there's a population maybe of 8,000 or so, but as you get any lower than that, the economic drivers just don't exist to support occupancy if you start having collection issues. But I do enjoy the tertiary markets. We've done very, very well in many different tertiary markets. We've gone into tertiary markets. We have no idea, anything about those locations. But I think a lot of people are scared of some of the smaller markets, but you can get all the data you need on Google. So, I mean, I can find out as much as I need to know while the broker's pitching me on the phone, just by, Wikipedia or, all the other resources that are available to you online. But I find apartments are apartments everywhere. People are people everywhere. And I really haven't, as long as there's a city within an hour, or maybe I prefer like 45 minutes, but we've had some of our biggest gains in smaller markets.
Nice. So your all's portfolio is spread throughout multiple states, different markets. When you're going into a new market for the first time, how do you do, what makes you all get there to where it's successful? What do you do? And what do you look for?
We're about as scattered as they come. We had a property this year in Muncie, Indiana, which I've never been to Muncie, Indiana. Apparently that's where Ball State is located. But we did very, very well on that property. Paid, I think it's 120 units. And I think we paid around $6 million and put quite a bit in CapEx and sold it for, well north of 10 million inside of 12
Oh,
months.
wow.
And again, we had no idea anything of that market or about that market, but we have an operational plan and we execute it in all markets. And generally we're moving crew around, but sometimes we'll bring on local crew. But it goes back to being a basis buyer and in my GRM models. If there's a solid basis play and if the GRM models are in line, we'll vet out what the normal operating expenses are for any particular market. And I think that's probably the biggest key, is vetting out what operational expenses are. You can underwrite all day long and pencil deals out all day long, but what I find I really need to know is, what is the average in that market? What is the average operator doing in that market in terms of OpEx? And there's no better way to find that out than calling the local brokers that sell that routinely, because they know. So for example, let's just say in Mebane, North Carolina, I probably can operate in that market around $3,500 per unit per year expenses. I might not be able to sell a deal at that level because a broker may say, hey, you might be able to operate that. But if I'm going to put my name on it, most people in that market will be 4,000 per unit or 4,500 per unit. So I'll underwrite my exit to either 4,000 or 4,500, knowing that I will outperform that while I own it. But so Mebane, North Carolina, maybe I do 3,500 OpEx, whereas let's say West Palm Beach, Florida, that might be $6,000 per unit. So you really need to know what the expenses run in any particular market as an average, and then you can kind of pencil out where you're going to be. So it's more about understanding OpEx, I think, because rent's really easy to vet out. All you have to do is, start Googling rents in certain markets. I mean, the first thing I might do if somebody tells me the average in-place rent on a deal, let's say for argument's sake is, $800 or $1,000, whatever town we may be, I'll start Googling average rents in that town and see what I come up with. And so the rents are really, really easy to vet. And if that doesn't put you at ease enough, well, you just start calling the local apartment complexes within your community. But understanding OpEx is the key to knowing where you're going to be. And I buy so many deals and I don't even look at the seller's T12. I find out firsthand what the average for OpEx is in that market. And then I know I'm going to probably, because we're good operators, that I'm probably going to be at or below the average. But I still have to underwrite to maybe at the average or just below for exit, or I'm sorry, just above for exit, because the next guy, and then of course, just for taxes.
That's huge. That is absolutely huge. So every, the rents, but in different areas, different markets, the operational expenses can decline or incline. It just depends. And then you managing the asset on your end, you can control those expenses to some degree.
Yeah, I think so. Correct. Well, I maybe got a little cocky, a little arrogant. And I was looking at a deal in Shaker Heights, which is an area in Cleveland, a little bit more affluent. I think I don't really know that market very well, but it was a market I was new going into, or I was trying to, and I really liked the deal. I think the rents were like maybe $700, and the next door neighbor was $1,100. But the purchase price was in line with those average rents of $700. So I thought, wow, this is really going to work out. I was so happy, and I was going to go like $500,000 hard day one. So I just thought it was just a huge win. But as I started to vet it out a little bit, and before I really got involved in a PSA or anything, it turned out that the taxes in that area were astronomical. A number that it was so absurd that I just couldn't believe it. So it was like I want to say it's like 5% of purchase price. I'm just like roughly as a rule of thumb. So it just skewed my numbers so heavily that we had to obviously back off of that one. But generally, if you're in a market you know your OpEx in that market. If you're, let's say, for example, own properties in Houston and you're buying another property in Houston, you should be able to operate at the same numbers that you're running down the road. But the key to going into those markets to me is understanding the average operating expense in that market. And if you really want to be safe, add $500 per unit, to whatever you call 2 or 3 brokers, they'll tell you what the average, expenses run in that area. If you want to, if you have $300 to $500, you're definitely going to be safe with that. As long as you're adjusting for taxes as well. Insurance is a new thing that's really creating some havoc. But normally we're just adjusting up for taxes. Now we have to adjust up for insurance, which is almost unknowable at this point.
Yeah, that's huge for anyone that's looking to get into multifamily, is looking beyond the operational expenses, the taxes, and factoring those in, because someone new excited about the potential rent bump there could very well have gotten that under contract and put the EMD money hard day one, meaning that it's non-refundable, and come to find out that the property would operate at a negative just from the taxes alone.
But yeah, quite honestly, insurance, like for example, I'm pretty big. I really like the Gulf Coast region right now, particularly Ocean Springs, Mississippi, and Gulfport, in that area. It's an area where maybe in years past I was afraid of, but until I started checking some of the school ratings, and I'll tell you what a key indicator on what kind of neighborhood you're buying. If you just go right to school ratings, a buddy of mine got me interested in this Ocean Springs deal we did. It was 240 units. Again, it was my largest deal. It was I think a $27 million acquisition. And I was like, no way am I paying 110 a door for that asset in that market. I said, I did a deal down the road in Pascagoula, and I think I paid 30,000 a door. And quite honestly, it didn't look much different than this deal. But once I started noticing, looking at the school district, and the school ratings were 10 out of 10 and 9 out of 10. And it starts to really tell a story on who lives there and the affluency, and that people care about their community. And the rents on that deal were pretty low, but we were easily able to move those rents from like 700 to 1150. And really,
that's huge.
Yeah, really value. But so that was kind of a new one on me that I always kind of looked at it, but never really honed in on. Maybe because I never saw a 9 out of 10 or 10 out of 10 school rating. But yeah, it was great. I think when I see properties that have those kind of school ratings, I run to those if they're within my strike price range on my GRM model.
And that property's got economies of scale. Just the amount of units that you have there that you can implement the rent bumps still.
Yeah, I do a lot of small deals too. I mean, I can't tell you how many 40 and 50 and 60 and 70 unit deals we've done, but it's been a whole bunch. But we find yield there, so I like those.
Those are hidden gems. They're definitely hidden gems. So a lot of these players won't go anything under 100 or even 200, and there's a little sweet spot, a honey hole in the 20s and 40s.
Well, when you can, let's just for argument's sake, throw a hypothetical. Let's say you can buy a 40 unit. I'm going to go on the small end. If you can buy a 40 unit deal at 50,000 a door, let's just say, for example, and it's newer vintage, that's $2 million, and you put a few $100,000 capex into that, so maybe you're 2.3, 2.4 into the deal, and you might be able to sell that property stabilized or with whatever value add you're going to do at 3.5 or 4 million. I mean, how do you say no to that? The equity gain on that and the equity checks that it takes, it's just, I have found it very worthwhile. And I think that in this very high demand market over, not so much this year, but in years past, some of the really big players have gone smaller and smaller and smaller in their asset sizes. I've kind of made a living in that range and zone for, better part of 20 years, but I'm still buying. I mean, I'm finally in a position where I can buy those 2 and 3 and 400 unit deals, but I find that most of my acquisitions are still between 50 and 150 units because I'm a yield chaser.
With your experience, you've got market rate rent, and then you've got your subsidized rent, your affordable housing. What have you found more success in?
That's another great question. It's kind of like I think I said before, apartments are apartments everywhere and people are people everywhere. what I like about the affordable, first off, I was pushed into affordable mentally, just because we had gotten to a point, like when I started, cap rates were 9-10% for a C-class asset. And over the years, I remember, selling a deal at an 8 cap that was a C-class asset. And I was like, wow, you think I can sell it at an 8 cap? And then I remember talking to some brokers out of Charleston. Actually, his name's Mark Boyce, really strong broker, and in the Carolinas. And he was like, hey, you want to sell this deal? I can sell it for you probably around a 7 cap. I said, you can sell that at a 7 cap? I said, I'll sell everything I own at a 7 cap. Of course, we did, but then I started buying 7 caps back. And that compressed all the way down into the 4s. So I just think that, where we are currently is more of a normalization of markets. Got really where I was headed with that. Sorry, I apologize. But, we have to, I think we have some pressure to transact in all environments and all economies. I think if we just can try to see out into the future as far as possible, I think that, like I said, for me right now, I think that vision 6 to 9 months, maybe, at least 6 anyway. But better err on the side of caution than get yourself into some deals that I think that long term we're all okay if we can just hold on. But I don't want to work for free for 12 or 24 months until maybe something turns again.
Love it. Jay, we truly appreciate your time. If the listeners, if any of them would like to reach out, learn more information about you or your company, how can they get a hold of you?
JAY@multihousing.com.
That is perfect. That is perfect. So I'm going to also include information in on the posts as we send those out. Jay, again, a ton of information. We truly appreciate your time, and we will certainly talk soon.
Thanks, buddy. Enjoy
All right.
your day.
Thank you. Bye.